So hello everyone and welcome back to another video here in Selena US Talks. To- today's video will be about what's ahead for the market this week. This week could move the entire market. So today we're going to discuss the key events to watch. If you don't know me, my name is Selena. I trade US stocks and the indices of the US market, and I help beginners learn how to trade fundamentally, technically, and sentimentally. So make sure to follow, like, and subscribe. And also make sure to make a comment and let me know what you think of my videos. And if you have any topic you want me to discuss, please feel free to let me know. I'll appreciate it a lot. So we have an interesting Wednesday coming tomorrow where we have a lot going on, especially with the situation that we have in this world. So this could be one of the most important weeks for financial markets in the near term because several major events are scheduled that could shift investor sentiment and potentially move the market in a big way. All eyes right now are on the Federal Reserve. Markets have been trying to price in the future path of interest rates, and every signal from the Fed has the potential to change expectations very quickly. So this week we have five key events investors are watching closely. First of all, we have the crude oil inventories, FOMC economic projections, FOMC statement, Fed interest rate decisions, and last but not least, FOMC press conference. These events could influence everything from oil prices to bond yields to major stock indexes like the S&P 500 index and the Nasdaq composite. So, let's walk through what traders are actually paying attention to this week. So, before we go through the specific events this week, it's important to understand why the economic calendar is so important for investors. Financial markets are constantly trying to price the future. Traders and institutions analyze economic data to estimate economic growth, inflation trends, central bank policy, and corporate earnings outlook. Every major economic report provides new information about the direction of the economy. When the data comes in stronger or weaker than expected, markets can react quickly. So, this is why professional traders always keep a close eye on the weekly economic calendar. So let's start with crude oil inventories. Now, at first glance, this might seem like a routine data release. The energy markets are extremely sensitive to supply signals. If inventories show a significant build, meaning more oil is being stored than expected, it can signal a weaker demand in the economy, and that could raise questions about global growth. On the other hand, if inventories drop sharply, it suggests demand remains strong, which can push oil prices higher. And oil prices matter much more than people realize. High oil prices can influence inflation expectations, transportation costs, and even consumer spending. And as you know, are suffering a major crude oil crisis, the one that we had never suffered before in the economic history, because 20% of the oil that we consume every day is coming from the Strait of Hormuz, which is actually being suspended from shipping right now due to Iran and Middle East conflict. This had made oil prices go up to the sky last week and still rocket skiing this week also. We have seen major indices and stocks losing much value last week, and it had been the worst week for Wall Street since last October. Also, if you can see here, the forecast is zero point 0.4 million barrels from the previous 3.8 million 800,000 million barrels from last week, from last month, sorry. So it's more than, I can say, 9 times or 10 times. It's less, 10 times more than the previous forecast. Okay? So this report may not directly move the stock market dramatically on its own, but it can influence the broader macro narrative that investors are watching, especially in these conditions of market we have right now. If the increase in crude inventories is more than expected, it implies weaker demand and is bearish for crude prices. The same can be said if the decline in inventories is less than expected. If the increase in crude is less than expected, it implies greater demand and is bullish for crude prices. The same can be said if a decline in inventories is more than expected. Okay, so next we have the FOMC economic projections, which is one of the most important pieces of information investors will get this week. This report essentially shows how policymakers at the Federal Reserve view the future of the economy. But the main focus will be the dot plot. The dot plot reveals where individual Fed officials believe interest rates should be in the coming years. Markets watch markets watch this closely because it can signal whether policymakers expect rates to stay higher for longer or eventually decline. If the projections suggest that interest rates will remain elevated for a longer period of time, equity markets could face pressure. Why? Because higher interest rates increase borrowing costs and tend to reduce valuations for growth companies. But if projections show a more optimistic path where inflation is expected to decline and rates eventually move lower, markets may interpret that as a supportive signal for risk assets. So, this release often creates immediate reactions across stocks, bonds, and currencies. So, shortly after the projections are released, the FOMC statement will come out, and this is where things get interesting. Investors do not just read the statement, they analyze every word. Even subtle changes in wording can send signals about how policymakers are thinking. For example, if the statement emphasizes concerns about inflation, markets may interpret that as a sign that the Fed intends to remain cautious. If the statement highlights economic resilience or improvements in inflation trends, investors may see that as a more balanced outlook. This is why financial markets often react instantly when the statement is released. Algorithm and institutional traders analyze the language in real time, searching for any shift in tone compared to previous statements. So then we arrive at the main event, the Federal Reserve interest rate decision. Interest rates remain one of the most powerful forces in financial markets. They influence borrowing costs for businesses and consumers, impact mortgage rates, and shape the valuation of assets across the financial system. Even if the rate decision itself matches expectations, markets will still react based on the broader context. Investors will be asking questions like, is the Fed signaling that rates will stay higher for longer? Are policymakers becoming more confident that inflation is under control? And is there any indication or future policy shift? And what is the next policy direction? So, because ultimately, markets are forward looking. It's not just about the Fed. What does the Fed does today? It's about what investors believe the Fed will do next. So forecast is 3.75 and previous was 3.75. And in my own opinion, I think it's still gonna be 3.75 for a very long time, especially in the market conditions we have today, okay? So finally, we have the FOMC press conference, and this is often where the most important signals actually emerge. During the press conference, the Fed chair answers questions from journalists and provides additional context around the decision. Sometimes, the tone during the press conference can shift the market sentiment dramatically. For example, if the tone is cautious or emphasizes economic risks, markets may react defensively. If the tone is confident about economic conditions and inflation progress, while investors may interpret that as a positive signal. Markets often experience volatility during the press conference because traders are constantly adjusting their expectations in real time. And sometimes a single comment can move billions of dollars across the global market. So, overall, this week's financial calendar is packed with events that could shape the direction of markets in the short term. From energy market signals to central bank policy guidance, investors will be closely watching every development. The biggest theme this week will be how the Fed Reserve views the balance between economic growth and inflation because ultimately interest rate expectations remain one of the most important drivers of global market. So thank you for watching and stay tuned for more market analysis and financial insight. And by the way, we're building a community for traders who want to make the best out of 2026. So if you're interested, just click the link in the first comment and you'll find out more about it. We have special offers and great tips and advices for you waiting for you there. So hit us up and let us know how can we help you and have a good day. See you in the next video tomorrow.